Welcome to Blue Nile Tutorials. In today's session, we're kicking off our 8th chapter, Income from Self-Employment Introduction. Being self-employed comes with unique opportunities and responsibilities, especially when it comes to taxation. We'll break down the basics of self-employment income, exploring what counts as taxable income, allowable expenses, and how profits are calculated for tax purposes. Whether you're a freelancer, contractor, or running your own business, this chapter will help you navigate the fundamentals with confidence. Let's dive in and simplify self-employment taxation. Grab a pen, and let's get started. Welcome to this video on income from self-employment, an introduction. The calculation of a figure to include as income from self-employment for a particular tax year is a lengthy process with many things to consider and calculate. In this session, we'll just consider what the overall process is. Firstly, let's think about what we're working towards here. This will apply where an individual runs a business, either by themselves or with others, but have not created a separate legal entity for that business by forming a legal company. For example, John and Joe work together, trading as GG Supplies. This would be a partnership, and each of John and Joe would need to include income from self-employment when calculating their income tax. Before we think about the calculations we will need to do, the first thing to consider is whether there is a trade at all. It's not an exact science, and each MRC will use what is known as the badges of trade to make a judgment as to whether there is a trade being carried on, and therefore trading income that should be taxed. No one badge is more influential than another, and it really is a grey area. The badges are the subject matter of the transaction, so are these the kind of goods or services that are normally used for trading? The period of ownership. The longer this is, the less likely it is that the item is part of a trade. The frequency with which this type of transaction has occurred. The more frequent, the greater the likelihood there is a trade is going on. Any supplementary work or improvements made to the item before it's sold. So this doesn't necessarily mean a trade is definitely occurring, as often people will want to make improvements to an item for their own enjoyment, but it's just trying to build up a picture using these badges as to whether there is a trade. Any marketing undertaken in order to sell the asset. Again, on its own, this wouldn't be enough to prove a trade was in existence, as often people will use an agent to sell something. The reason for the sale? Was there suddenly a need for cash that meant someone had to sell an asset that they otherwise wouldn't have? If so, then that suggests there may not be a trade here. The motive for the transaction. Was it to make a profit? If so, that suggests that there may be a trade happening. Those are the main badges of trade, but there are 3 other questions each MRC might use to make their judgment. What was the method of acquisition of the asset? If we inherited an asset and then sell it, it's much less likely that we're carrying on a trade. What was the financing of the asset? If we've taken out a short-term loan, for example, to fund an asset purchase, it's more likely that when we sell it, we're doing so as part of a trade than if we'd taken out a long-term loan. And what is the similarity to existing trading activities? If this transaction is quite similar to activities that the individual already carries on as a trade, it's more likely that this particular transaction is also trade-related. So remember that no one of these questions or badges is more important or decisive than the others, and we need to make a judgment after considering them all. The business will have prepared accounts for some period of time, which will give us a profit or loss figure for that period. However, there are some issues with this for tax purposes. Firstly, the profit or loss calculation. Accounts are prepared following accounting standards, but some of these allow a business choice as to how to deal with a particular item. Tax authorities prefer rules which mean that everybody is treated the same, so this choice is one problem, amongst others, that we will need to look at, with the profit or loss calculated in the financial accounts. Secondly, we have the period of time. A business can choose to prepare accounts to any date each year, whereas tax calculations are prepared for the tax year, which runs specifically from the 6th of April of one year to the 5th of April of the next. So in this introduction, I wanted to give you a step-by-step approach to follow to calculate income from self-employment. In later sessions, we can then look at the specific rules and details for each of these. Step 1. Adjustment of profit for the accounting period. For now, we'll ignore the issue with the dates and work on the figures that we've already produced in preparing the financial accounts. This first step will be an adjustment to the figure in the accounts to remove anything HMRC will not accept and perhaps replace it with something better. Step 1A. Capital allowances. One of the biggest areas of concern for HMRC is the depreciation charge included in the accounts. A business can choose how to depreciate its assets, therefore the expense shown in the profit calculation may differ between businesses even when they buy the same assets. As part of the adjustment of profits, we'll always reverse the depreciation entry shown in the accounts, but as the business has spent money on plant and equipment, we'll replace that depreciation with something called capital allowances. The calculation of these allowances could be very large and complex, so there are many rules for us to look at to see how we deal with this stage. Once we have worked through steps 1 and 1A, we will have a tax-adjusted trade profit, but this will still be for the accounting period. So we still have a problem with this, perhaps being for the wrong period of time. We'll therefore need to move on to step 2, which is looking at basis periods. Basis periods is the name given to the rules we adopt to decide which accounting periods to look at for the given tax year, either in full or in part. These rules are again lengthy and complex, and so we'll look at them fully through a series of sessions. Where the business we're looking at is a partnership, there will be a further stage to consider between steps 1 and 2, which is to allocate the profits between the partners. And one final area for us to consider with self-employment is how we deal with the situation where the business makes losses rather than profits.